We all know that inflation numbers matter, but what UBS just said about the US economy may absolutely surprise you, with volatility potentially set to spike massively into this November. Today we take a look at the data, the key levels, the movement in gamma over the last 24 hours, and more importantly, some of the big charts in things such as the AI bubble. Could this head and shoulders really be playing out in front of our eyes? And what does it mean for us as traders and investors? Also, with demand dropping across iron ore and big oil, what is actually going on underneath the hood? Let's discuss it today as we cover stocks, commodities, and cryptos moving forward. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we'll be taking a look at all of the latest happenings in the markets, including the macro, the data, and of course the flows. So to begin with, before we get into the UBS call here, which will surprise you, let's talk about FundStrat's Tom Lee. Obviously, he's quite bullish, but he also is starting to think that maybe volatility could be set to spike based on the data of previous election years. Now, we've discussed this for a while, an uptick that begins into August and runs through actually into October generally before the election. And it often leads into market lows happening somewhere around August or October. In fact, the stats realistically point to those 2 months being worse than September itself. Now, we have been talking about September being part of what we call a kangaroo style market, where it resumes an upward trend and then starts to go up and down and all around with incredible volatility. But just remember, although the stats point to a VIX peak in October most of the time, we did hit a 65 in August. Historically, a level that you almost never see. I've only ever seen it a few times in my trading career, and that's been going for quite some time now. So let's take a look now at the bear cases and the bull cases. First up, we'll go with the bear case. Of course, the big one here are people talking about semiconductors. We know that AI is a bubble. We also know that long term, it is the future. Now, why do we say it's a bubble? Well, of course, valuations are relatively rich on a lot of these companies. And it has a lot of people saying that this could be what we call a head and shoulders pattern. Now, if that was to come true, and of course we know that at the moment we have dark pool transactions, that is large Wall Street transactions happening right around these levels, thought to be buys at this stage, this will be a big factor. Because of course, if we end up breaking to new lows, the ability for this to happen would basically cause us to go into a market meltdown. Now, could that be true? Well, of course, iron ore is falling off as China continues to worsen, even with it trying to support the economy, and hedge funds are slashing oil bets across the board, often considered recessionary style moves when it comes to these metals. But of course, inflation is about to happen in terms of the numbers, and we do know that we're following a similar trajectory to the 1970s. We've got a path that actually looks very, very similar. And over the next few months was traditionally where we started to bottom off in inflation and started to see it come back. We'll show that chart in just a few moments, but let's talk UBS for a moment because people are sharing this throughout the internet and it looks like they're going really bearish. Over the next 2 months, they believe that Russell 2000 will lose at least 10%, including IWM, XLF, and high yield junk bonds, basically being the main targets for hedges or shorts. And they think that because of this increased in volatility into the election, because of the dynamics of breadth starting to decline a little bit in recent days, that they're going towards the side of potential really big weakness. Now, of course, I think one of these calls is got to do purely with the rate cut. And we do know the rate cut is coming. And of course, when we talk about rate cuts, usually the first 5, 10, and even upwards of 21 or 63 days can be up, down, and all around. And the speed of the rate cut will be important. Now, I've talked a little bit about this with you guys before. We've all discussed it. And we've always thought that we're following a similar path to 98 or 2019. Now, I don't agree that it's a fast cut then. It was a fast overall cut, but obviously a slow start. And at the moment, we're thinking 25 basis points is where the cut's going to lie. In fact, most economists also do think that. And as long as it is 25 basis points, the chances of us following a 98, 2019 path become higher. Remember, if the Fed panics and goes towards a 50 basis point, that really tells you something is quite sick underneath in the economy, and they're expecting, let's say, an acceleration in jobs losses. Here are the difference between fast cycles and slow cycles, and you will notice some of them do end up into the upside here, and some, of course, go into recession. And it's going to become very important because these are the reads. Remember, we talk about 2019, we talk about 1998. And in both cases, while we were in kangaroo style markets coming in and we were in kangaroo markets going out, remember going out would be October, we end up making that directional change towards the upside. Of course, if we go towards the downside and we end up going negative in October, negative in November, possibly some negativity in December, that's starting to point towards, not so good for markets. In fact, that's realistically telling us the market structure has changed and they're sensing impending recession. Now, a lot of you in the comments always say, Tom, the recession's already here. And we do know that we are in late cycle investing. So, of course, Wall Street is realistically going defensive. At the same time they're going defensive, what else is happening? We're seeing central banks around the world becoming incredibly accommodative. Oh, here's some liquidity. Oh, here's a rate cut. Oh, here's some spending from the government. This is what we always talk about in late cycle. So when it comes to the forecasts, we have to expect they're probably going to be on the money here. The expectation is median forecast 0.2%. We post this over on X from the Wall Street Journal. And you can see here that realistically, most of the big banks are in line with their overall calls. Some are off a little bit, but I think it's probably going to come in around 0.2%. So what are some of the big bull cases right now in the markets? Well, there are some good signs. Of course, day sales of inventory year on year have started to spike up. And in similar periods where we saw these types of turns, it meant that we were in a recovery in the economy. We've also seen inventory also go positive for the first sign here, which you'll notice when you're looking at those last previous recessions is also a good sign for the markets. And this is early stages of a sign of a recovery or an expansion cycle. And it's not usually what we see in economic weakness. At the same point, earnings estimates continue to be improved by overall the banks. And of course, we have seen Morgan Stanley, we've seen Goldman Sachs, and we've seen JP and everybody else basically continue to say they believe the American economy is expanding at this point with GDP revisions to the upside. But at the same time, what else are they doing? Well, they're going defensive. Utilities, healthcare, consumer staples, all of these main markets here are starting to see really big upticks. And we note that Goldman Sachs actually recently seems to be overweight in some of our favorite sectors at the moment into these rate cuts. Why could that be? They're hunkering down a little bit for, of course, the increased volatility expectations when it comes to this election period. And at the same time, they're starting to buy into that late cycle. We're probably anywhere between 6 to even 12 months now into that. And we do often look for late cycle using the code XLY versus XLP, which we've talked about before. Consumer discretionary versus staples. When that's going sideways, you know you're in a period of sluggish growth. So the other big question is, have the bonds market got it right? Of course, the bonds market is predicting a recession is probably on the cards. Why? We've had an uninversion of the yield curve. And when we tend to see uninversions of the yield curve, sometimes the markets will go up, and in recessionary periods that are impending straight away, the markets will go down over the next few months. This is why the next 1 to 3 months in particular are so important to the markets. A rate cut, UBS freaking out, the election, and on top of that also this market structure when it comes to uninversion of yield curve. So why is it so important to be watching the inflation numbers now? Have we dealt with it? Well, maybe. It looks like we have. Of course, we're following a similar path to the 1970s, but that's where the problem really lies. When you overlay them, you'll notice that we're coming into the point where last time we saw some of the lowest reads of inflation. With the stimulus that the Federal Reserve wants to put back into the market, and of course central banks around the world and governments are spending, that could re-spike inflation. And I think this could be the story still to watch into 2025. Of course, here on the channel, we will be specifically following this so you guys can be informed if we are following a similar path to the 1970s. Because if we are, well, it didn't end very well. And of course, that could trigger some serious moves in the market to the downside. For now, though, we have to question, did the Wall Street biggest players start to buy into the dip? Well, of course, they don't do it all at once. They usually position their investments over time, and a lot of them are positioned, and the market is positioned as we expected, into the inflation number just before a huge resistance point. On something like NVDA, we saw dark pool transactions come through, and we do know there's a high resistance up here at the 110 level. On stocks like SPDR, SPYV, which is basically just value SPY, we've seen some large transactions and somebody may have bought or possibly sold up here in anticipation of the CPI number. So it's led us to basically seeing markets stabilize at a key level. And we know this because across the board, realistically, other than things like TAN, solar, or energy, most of the markets are still sideways or even up over the last 5 days. So we've got kind of like a mixed market coming into this event. Let's now have a look at the S&P 500 from the price action based standpoint. What's going on here? Well, it's become pretty clear that we've got a point where the markets need to break up and out to get back into the bullish side. We have a big breakout that happened recently. We suspected that there could be weakness around here. We got a pullback, and of course that pullback filled one of the gaps on the SPY, leaving another one now, and filled both of the gaps on the Qs. So now that we're here and we see this little uptick, of course, if the CPI number is favorable to the markets, however that may be seen, we need to breach through these highs, particularly the daily 20 moving average. And of course, if we could breach around 55.50, which you'll notice in a moment is an options level, that will be key. Let's move over to the options low and highs for the day of CPI. You can see they're quite extended. So this is basically telling you where the supports may be, which is the previous session low, and where the resistances may be. Notice the options high level expectation is 55.50, exactly where you would expect big problems to happen for the bulls. That's effectively one of the most important areas. The 20 moving average also just so happens to appear on one of the most traded zones on the way down. So effectively, this is the area to be watching as a day trader as well. So let's have a look at the options flow. What's the options flow tell us? 54.50 where the puts are, 5,500 where the calls are. Now, if the market actually breaks to the 5,500 plus close by the end of the day or starts to move there, we're going to enter into a positive gamma event. Effectively, the market will start to eat upon itself on the upside, something similar to what we saw over the last 24 hours with Tesla. On the downside, though, we could enter into a massive negative gamma event, which we currently are in, where we could go underneath 54.50. And you need to remember these levels because as we hold underneath those zones, effectively these biggest hedges in the markets, they're having to effectively hedge off their position, and this causes those waterfall style event periods. So the next 24 hours will be important. And at the moment, the key levels, 50, 450, and 5,500. And both of these zones will be probably, or at least one of them will be tested, you would have to think, after the CPI number. NASDAQ versus CTAs, we know that, of course, S&P 500 and NASDAQ CTAs have both been in decline. They did buy a little bit on the dip in terms of this recent little uptick, and it's usually about 24 to 48 hours behind. So, of course, that will be important to note. We've also seen Brent CTAs dropping big time. This is now historically oversold, so we're in a market that's now more interesting for oil. You'll notice over the last couple of weeks, we've been very kind of like dubious on oil buys because, of course, there's been no structure. On top of that, it looked like the market was moving towards the next equilibrium, but we're approaching that level right now. This is around where you would expect oil to start to form a base. And of course, it could be a great opportunity, especially post CPI, if we see the right types of price action, which we'll talk about in upcoming videos. So stick around for that. Now, on the flip side of the negative gamma or the neutralized markets of the SPY, have a look at this chart on Tesla. It continues to be very strong. And we've talked about this now for about a week. Basically, Tesla has some of the best overall gamma for the positive side when it comes to everybody trying to pile in on this stock. And it looks like it could continue. We're sitting at 226 at the time of this recording. We've gone up, of course, above the 220 threshold here for this week. And if we continue to stay strong for the week, especially getting through 230, this could really start to pile in, creating that positive gamma squeeze that so many in 2024 have enjoyed. On something like NVDA, it looks totally different. 110 is the big res, that's where it goes positive gamma, and everything down here is just kind of like, there's some buyers, there's people around, and anywhere between about 100 and 107, 108 is realistically where we have seen some buying pressure. But 110 remains the key resistance point for this market. Let's jump into the rest of the charts. We're, of course, very aware that we've now uninverted the yield curve. I think no one can deny that that's what we've done now. So we've started the ticking kind of clock, and we know now we're in structural formation. So what happens over the next 3 months will tell us a lot about the next 9 months past that point and help us, hopefully, as investors and traders, to better define what's actually going on through that period of time. When we go through the markets, we know the markets have turned defensive. Late cycle is upon us. Utilities over here and healthcare over here, both improving versus the SPY, especially healthcare over the last couple of months. And this is again showing that people like Goldman, people like JP Morgan, big asset houses, they're starting to invest in a slowing, sluggish style economy, which looks like late cycle. At the same time, over the last 24 hours, we saw financials start to really tank, especially JP Morgan over here, losing a significant portion through the session. And this will become a big story moving forward. If financials start to weaken heavily, of course, that shows you something's wrong in the underlying economy. For now, it's not really something we're worried about. We are watching home builders as well, but it was worth noting because, of course, financials have been struggling through September after having a massive pickup in August. Continue to watch the charts, totally worthwhile doing so. Let's move over to the US dollar now and have a look at this together. We know the US dollar is at a critical point. It started to look like it's kind of topping and turning over at the daily 20 moving average. Of course, post CPI, as we often say, patience, react, don't predict. We'll probably get a better read on the US dollar and its next direction move. Meanwhile, in oil, absolutely tanked. This thing's heavily oversold now. And this is the kind of point when, let's say, someone that's a little crazy, I'm looking at you, I know that some of you guys out there are a little crazy. Maybe crazy people like to buy these kind of levels. I would always say look for structure, be patient, and react to the markets. But this is the type of level, especially around these lows of 63, 50, that kind of area, where markets have just completely oversold themselves. And we are starting to get the signs now, you can see an indicator like this, that all indications are completely oversold. Now, that is not a solicitation to buy it because, of course, you've got to remember you must look for structure in markets. But you'll see some things such as the extending period away from the 20 moving average that are starting to get quite far, even for oil. So this thing's oversold into inflation, and that's why we're watching it post-inflation to see how it reacts. It's going to be a very, very interesting chart to come back to post-inflation. Meanwhile, things like copper, gold, and silver, well, copper's been improving. Of course, it's still holding its base. This one will get tested during the CPI event. For now, it's kind of sluggishly bullish. And gold looking to do a big breakout. Now, you guys on the channel, you know I love the gold. I'm a believer of gold to 3,000, 3,600, these types of levels over the next 12 to 18 months. And it's already been doing amazingly this year. And of course, it falls into our late cycle style concepts. Now, gold has been moving in what we call a pullback in time, effectively a channeling or coiling market. Now, if it does break out post-inflation numbers, it could go into a bit of a momentum run. So, of course, next 24 hours will matter for gold. For now, the bulls are still in control of this market. Silver bulls also in control. This will be an interesting one to see whether they can push it above $29. And, of course, you've got to keep an open mind. For now, the most traded zone is where the buyers are. The market closes underneath these lows here. Well, it's going to keep going down at that point. And, of course, that's going to really push silver potentially into 26.50, which would be probably the next major level. Maybe 27.40 could be also important. Let's move over to Tesla 232. We know this looks like a head and shoulders, and this effectively is a pretty massive chart. Now, if it manages to get to 232, we know the positive gamma at 230 could be incredibly strong, and at that point, we could start to move towards the gap fill, which sits at about 247. So this area here will be important. If you take the head and shoulders, or the inverse in this case, and you actually break that down to what this would mean for the markets, and I always love doing this with patterns, this would actually signal that Tesla could move to 280. And that's a pretty big move. It's been sluggish for a long time. You might have negative or positive feelings on this one, but overall, of course, Tesla is one of those stocks that when it gets rampant, when people start to rage on it, we know it gets pushed really, really heavily. And we've been involved in a few of those here on the channel where we've seen them out of coiling markets. Well, I think 232 is going to be one of those inflection points, and it's one to watch, of course, with this ever-evolving gamma-style situation we're seeing. NVDA, we know 110 is the key level. NVDA did pretty well over the last 24 hours, did another 1.53%, starting to come up, but ultimately CPI will be the deciding factor for this. We also know that things like China are still struggling. I think with China, we know the HSI, which is not quite the main market, but it's one we've been looking at, needs to see a turnaround in iron ore and probably in commodities. Now, my suspicion is it's going to happen in October and November in terms of a bigger turnaround. But for now, the price action, we need to see a bid. And we can actually move down the price now to 17,300. For momentum style traders, we need to get back above this level, and then we could start to see some actual turnaround here. Doesn't look great on the charts. We need to see an improvement around this point. So we'll see where that can happen. Aussie 200, meanwhile, still pretty strong, decent market. Overall, the Aussie market is banks, energy, and materials and metals. So again, metals, materials, and energy start picking up. The banks are carrying this market at the moment, and that will start to improve. There are a bit of utilities and healthcare that's also keeping it up. US 2K, though, is struggling. So when we look at the Russell, it's not so good. And the Russell is putting pressure on that 2075 level that we've talked about. It got pressured over the last 24 hours, which I kind of suspected it may have. And the Russell loves, of course, being a bit naughty. This one here, it loves to take lows. It loves to get stop loss you out. It loves to do all the naughty things that you don't want as a price action based trader. And that's because it seems to be quite heavily manipulated by algos. And whenever you're looking at the Russell, you've got to say, have we seen a bid? So far, we saw a very small time frame bid around here. I think post CPI, we're going to get a lot more clarification on whether this market actually can turn. So we'll watch it. Most traded zone, very important point for the Russell. The Qs, we all know where the bulls take control. Daily 20 moving average, 465. This is the main market level. If you want the market level for the NASDAQ, there it is for you. It is the blue line here, which is 19,011. And we do need to remember that 18.9 is the most traded area. So again, anywhere in here is where the bears could push the market down and try to short it back down the kangaroo style. The other, of course, option is we ramp through this and then we're looking for pullbacks into buy style conditions. And this could be what we're in for longer term. So we do need to remember the next couple of months could be incredibly volatile, and therefore traders, even swing traders, may be looking at this market and saying this is a great time to trade because we have more or higher intraday moves. What about Bitcoin? Well, Bitcoin has great Octobers and bad Septembers. It's struggling on the daily 20 moving average, which you can see here is rejected 1, 2, 3, 4, and now 5 times. Gets through that. I think it's probably moving towards 60, 61. Basically, Bitcoin just has to hold 54. As long as it holds 54, that's a good sign. It is in a downward trend on the higher timeframes at the moment. But the big bull signs, the first one's going to get through the daily 20. The second one is, of course, going to break the structure at 60 to 61.5. And they will all be quite important in terms of what we're looking at. Core CPI, as we mentioned, 0.2%. CPI is expected to be 0.2, 8:30 a.m. New York time to be watching. And ultimately, we're going to need to be a little bit patient here and, of course, react, don't predict. In this case, it's one of those ones where you may not even know whether the result will bring big volatility, but we do know where the key levels are. And of course, the reaction post the event is really going to be what you're watching. When it comes to the longer term, you have to expect volatility over the next month and a half. And then at this stage, at least some of the manufacturing data and some of the other things are pointing towards the bulls being in control. We'll see how it goes. UBS, certainly feeling very negative. Fundstrat's Tom Lee, he's still trying to buy this dip. Out of control. All right, guys, subscribe if you enjoyed the channel, and we'll catch you in the next one.